The market's down about 100 plus points, and the sell-off which happened about an hour ago has not really been bought in or anything of that sort yet. 10,798. The reason this is not significant, but you take note of this because today is the day when most global markets are also going to come back to trade. The US futures indices, the S&P 500 futures, for example, they're done about 1.25% or so the last I checked. And maybe that is rubbing off here. Things could change. US markets and the way they traded towards the closing few sessions of 2018 was anything but linear. You had big up days and big down days and, a repeat of those movements a few times over. So, what the futures are indicative of and what actually may happen when US markets open could be different. But for now, I think that's what the market here is watching. And it's down. So 114, 115 points lower is what we've got on the Nifty. Anisha, Europe also opens, right? After the holiday break. So we'll have that up on the screen as well.
Oh, well, yes. So along with the global concerns, Prashant, we have our own domestic problems as well. We got the auto sales number for the month of December and they did not look enthusing at all. To add to that, the metal space is coming under a bit of pressure. That, of course, is partly related to how China growth slowdown concerns have been playing out. But nonetheless, it looks like the Indian markets right now under a tad bit of pressure. We did bounce back from the 200-day moving average of around 10,782. Let's see whether we are able to support that level or not.
Do we already have the European rates? They should come up, right? Let's put them up and take a quick look at what's happening. So we've got, all negative. DAX is showing about a 0.75% cut. FTSE is down 1.5%. Okay, DAX is not yet open, but on my screen. FTSE is down, CAC is down about 1.9%. So some of these markets are deeply in the red, but this is just, as we always say, the opening values and watch the space. Volumes even today, this is just the first day of them coming back in the new year, so volumes would be lower, but directionally it's pretty clear which way these indices are actually heading towards. So that's where we are at as far as Europe is concerned. But headlines, Anisha.
Oh, well, yes, let's come back to our own markets and let's see what is making headlines in the world of business right now. Market trades near the day's low after a sharp fall in the past 1 hour of trade. Nifty tests the 10,800 mark as heavyweights like Reliance and HDFC Twins hurt the most. Midcaps and banks also near day's low.
Eicher Motors is the top loser on Nifty today after Royal Enfield sales disappointed for December. Mahindra & Mahindra continues its decline. It was down 3.5% yesterday. It's down 4% today. Pawan Goenka tells cnbc TV 18 that November and December months were used to sell off the piled up inventory. He expects some turnaround in the last quarter of this financial year.
Well, more stocks reacting to weak December sales in the auto space. Hero Motor falls around 2.5% after total sales come in lower than expectations. Pawan Munjal says that there is an urgent need to reduce GST on two-wheelers from 28% to 18%.
Public sector banks in focus after Reserve Bank of India allows one-time restructuring of MSME loans not exceeding 25 crore rupees. Experts say RBI's MSME forbearance will impact between 10 to 13 lakh crores of bank loans. ICRA tells cnbc TV 18 that RBI forbearance can spoil the credit culture.
Well, metal stock lose on fears of a slowdown after Chinese Caxton manufacturing PMI contracts for the first time since May 2017. CLSA as well has downgraded most metal stocks today, cuts FY 2021 EPS for Indian metal companies anywhere between 10 to 40%.
Okay, Ashwini is with us, so let's get straight to Ashwini. 120 points lower, Ashwini. The bounce yesterday, I think you were negative in the first half yesterday, and I think we are down now. So how does it play out? Because we got a bounce, and then dips have been bought so far, but we're down 130 now.
See, the whole issue here is that we remain in an uptrend. Now, in an uptrend, which is possibly. We've done 500 points. You can easily lose 50% of the gains and still be in an uptrend. My sense is that, today the weak longs are getting thrown out. Some, initial short positions are coming in. And what often tends to happen is that in an uptrend, the short positions get trapped, and then you see a reversal. So I would think that today is a one-off type day. It may even close at the lows, but the idea should be to buy into the market rather than selling into it, because if tomorrow morning, Asian markets or Dow, etc., recover, and they are positioned for some sort of a recovery, then these short positions will get into trouble. Now, there may be a time when the market turns and turns for good, but in an uptrend you have to buy the dip at least till a certain point. So 10,750 thereabouts should be that point. If you buy here, your risk reward actually for buying is much better, and if you lose your 25-30 points, that should be it. So my sense is that it's probably premature to go short, and sometimes these sort of days create enough shorts for the markets to move on the upside. So right now you should be buying. Having said that, BEML is a buy with a stop of 910, target of 945. HPCL is a sell with a stop of 251, target of 235. And Sun Pharma is a buy with a stop of 430, target of 455.
But Ashwini, having said that the uptrend is still strong, we are sitting at the low point of the day. In fact, as we speak, we have made fresh intraday lows for the day. Which level or what level are you watching out for from where we can see a bit of bounce back? Because we have broken down the 200-day moving average as we speak.
200-day moving average is a zone. So that zone is, 10,750, 10,800. And, what often this does is, this gets even more people short of that 200 DMA is broken. Let 10,750 broadly get taken out for a couple of days, and I think only then you should make all of these assumptions. Sometimes these sort of corrections prove to be great buying opportunities, and that way if you see things are much better than they were 2 months back. So it won't be very easy for the markets to move lower as well. Today is a bad day, and that's about it, and maybe buying the dip could work out from here. I don't think selling here is a great idea.
Okay, fair enough, Ashwini. Thanks very much. So risk reward for going long much better is where Ashwini comes in at. And I mean, if you're trading, risk reward is everything. So we're down 136 points. Although it was interesting to see how easily and how fast the market, I mean, we started with a 120 point cut and suddenly in 2 minutes we're down 150. The pickup from the low is also as fast, 135 lower now. So price is changing quite fast. Let's get a global perspective as well. As we said, global markets are slowly limping back into action after the holidays. Manish Singh is Chief Strategist and Head of Investments at Crossbridge Capital, and he's joining us right now to take some questions. Manish, thanks very much. So will global markets, as they come back, pick up where they left off last year? The same themes, pondering about what the Fed did, what is priced in terms of rate hikes, that kind of stuff, or what's really going to be top of mind? Is it going to be the price action itself? Because the last few trading sessions, especially for US markets, were extremely volatile.
Sure. Happy New Year. What I would say is something that I have been repeating in the past as well. That obviously the Fed is a very important factor, but one also has to realize that in the US it's becoming very clear that Fed cannot just keep raising rates for a simple reason that their mandate is price stability and full employment, and there is no sign of inflation. So in the US, that should worry Fed. So Fed is going to back off. Fed is going to ease in the sense that they're not going to be so hard-pressed in guiding the market that rates should increase, and that should be a good help to the market. Now, that's one factor. Second, obviously, another big factor is the U.S.-China trade agreement, which, if you follow the tweets that Trump has been sending out for the last few days, has been indicating that there's a good progress on that. Now, you saw the PMI number this morning coming from China, which has dipped below 50. That gives them a reason to accelerate and do a deal, which they have always wanted to do. They're just seeking clarity from U.S. in what sort of requests that they have on what set of factors that they should deal with. And third, I would say that if data was to weaken more in China, then we get the Chinese stimulus again to happen. So my view is that one has to be very constructive, and even if you see some sell-off, I'm not a seller in this, I'm a buyer, and I believe that you're not going to have the same strong dollar story that you had last year. So a lot of emerging market battering happened last year. If dollar doesn't strengthen much, and I don't expect dollar to weaken, but I do expect it to not strengthen as much, and therefore I think the market should remain constructive.
So Manish, you're constructive and you remain a buyer, but you're buying which asset class? Are you looking at India as well, or do you think that ahead of elections the FIIs may stay away and it's only in the second half that we might see some serious buying into the Indian equities?
Well, that's a good question, because clearly elections do matter a lot, especially in emerging markets and for foreign investors. I mean, personally for me, because I do mostly country ETFs, I am still a buyer because I do believe that Indian economy is very well poised to do well. Now, of course, you have some misadventures from bureaucrats, when they start raising tax on startup funds, and all those are very, very unsavory, and it shouldn't happen. But always you have seen the government coming back and clarifying and taking those things back. So I am not as concerned. So for me, because it's part of my overall allocation, I am still a buyer. I'm not India-focused fund. So if you are only India-focused fund, then of course you have to be far more careful. But as part of my allocation, I'm not worried about the election. I think that Prime Minister Modi has done a good job, and probably he will be in a position to get a mandate again. If not in full majority, maybe in coalition, but I do expect him to come back. So on that basis, I'm still looking to keep my position as it is.
And Manish, in your earlier answer, you hinted at the China-US trade war, and we know this morning that a lot of Asian markets are coming under pressure given the fact that the Chinese growth numbers have contracted. But on the flip side, as you were mentioning, there were tweets both from the US president as well as the Chinese authorities talking about how the talks are progressing well and cooperation is the best way to go. Do you think we have seen the worst of these trade war concerns, or do you think this is one thing that might continue to plague the equities in 2019 as well?
Sure. So I would say that, the talks are definitely progressing well if we are to believe what's being tweeted and discussed and the comment from both sides. And of course, there's also reason to believe that it's not just only China is going to benefit from this trade deal. US is also going to benefit a lot much. And in the sense that you have seen the weakening in US data. Now you have seen certain exports from US not going to China at all. And also this trade deal is going to open the Chinese market to American products. So of course it helps America as well. So therefore I have been saying for the last few months is that a deal has to be done simply because it benefits both sides, not just one side. And what will really put the pace on this deal is that in US, by end of Q1 and early Q2, you will have the start of the US presidential cycle. And then clearly the data has to be strong in the US for Trump to make a case to get reelected. So you have that political angle as well. But more importantly is the economic one, where both sides do benefit from a trade deal. U.S. has much more access to Chinese market that helps the US economy. And China always doesn't want to be stopped in its progress it is making. And they don't want U.S. to support them and not let them go.
Okay, Manish, so thank you so much for joining us. So remain constructive as well as equities is concerned and positive on that asset class. But in fact, as we start 2019, we have been taking a look at how these asset classes are really stacked up at the start of this year. In fact, Prashant has been doing some analysis on this, and he's joining us with this snapshot of the details.
Well, I thought it would be a good idea to actually look at, stocks, currencies, oil. Actually, the only thing I'm not looking at is yields, and especially US yields. But I think what I'm going to put out gives us a fair idea of where financial markets are really poised at. Let's start straight away. Let's dive in to the one sort of value which is probably watched the most closely around the world for equities, which is the S&P 500. Now, the S&P 500 is actually... It touched and bounced off the 200-week moving average, which was 2,350. 2,350 was that level, and we've kind of bounced off it. We've had one other instance of the S&P 500 coming very close to the 200 weekly moving average. This was 2 years ago. And from there, the market doing very, very well. Let's see if we see a repetition of that. But, the fact is, it looks like, tentatively, fingers crossed, maybe the worst for now is behind us. I mean, there has been a touch and a bounce off the 200-week moving average. Let's come to the Asian equity spec. I mean, generally speaking, I mean, before I get to, I'm talking about two specific indices, Hang Seng and Nikkei. Generally speaking, Asian equities have done pretty well in the last quarter, Q4 of calendar 2018, when you contrast that to the sell down that we saw in US markets. So the Hang Seng, for example, remains around or just above the 200 weekly moving average, which is again, I mean, you could call it the big Lakshman Rekha. And the same indicator I was looking at for the S&P 500 as well. The Nikkei seems to be, I mean, the big market, the Japanese market seems to be in a bit more trouble. It's still below the double top neckline of about 20,347, and it needs to at least come up above this on maybe a weekly basis for some confidence to return. You can talk about India as well, but I mean, India is actually an outlier. India is perhaps the only big global equity market, maybe apart from Brazil, which actually returned positive for 2018. So I'm not going into India at this stage. Let's move on. Let's look at let's look at oil. It crashed. And maybe, that the last leg of crash in oil prices wasn't too much expected, but it's showing indecision at the lows, no real sign of what it's likely to do. It needs to bounce, I mean, and maybe on a weekly basis. So I think that will be watched pretty closely. So no real directional kind of cue here or even levels nearby as far as oil is concerned. The dollar index, well, it's testing the double top neckline at 96.04. So it needs to hold that. But generally speaking, I mean, if you look at not just the dollar index, but the dollar against a variety of other currencies, the dollar is looking, I mean, the setups are looking weak. I mean, essentially the dollar is looking weak against most currencies. Look at the USD INR, for example. It's on the 200-day moving average at about 69.27. And, the next support levels for the dollar come in at about 68.78, 68.86. So, watch this carefully. But as I said, across the board, the dollar's setups are looking a little weakish. So that's where we find ourselves at. Equities, I would say, a bit more constructive after the sell-down, meltdown we saw, especially in the US. Asia has been doing better. Oil, not really decided. But, you'd find supporters for stronger oil and a weaker oil, those who want equity markets to be stronger. So we'll see how that one goes. And currencies, a generally more subdued kind of dollar, which isn't bad news for emerging markets. Back to you.